Welcome back, folks. This is price action model number 11, 30 pips intraday trade model, day trading model trade plan. That's a bit of a tongue twister almost, wasn't it? All right, ICT price action model number 11, 30 pips intraday trade plan, day trading model. Now, before we get into it, model number 11 and model number 12 are considered, by my definition, as a bread and butter type model. So they're setups that are going to happen most frequently, and as a result of that, they have a higher strike rate, or they should have a higher strike rate, but they should not be your go-to initially. Okay. The reason why I say that is because it requires you to know the most about the content and how you engage with price before you start working with lower R multiple setups. I don't require 3 to 5 to 10, 20 different R model return for one risk. These models, 11 and 12, tend to be lower in their return relative to the initial risk. Now, that's not meant to discourage you. It's just meant that you don't try to get rich with these types of setups. Just because there's a plethora of them forming doesn't mean go in there, go hog wild on every single setup and over leverage every single one of them. So with that, let's get into it. Like every model before, there's 5 stages to the trade plan development: preparation, opportunity discovery, trade planning, trade execution, and finally, trade management. Okay, preparation. We're going to note all medium and high impact events for the markets that you're going to be following. Study the events of the week to come and consider how the current market structure and calendar events may suggest a specific weekly profile for that week's range. We're going to be determining the IPTA data range for the last 20. Now, it's very specific with model 11 here. The last 20 trading days is all that's required. We do not count Sundays. We're going to be noting the highest high and the lowest low in the past 20 trading days. This is your current dealing range. Inside this dealing range, we will look for the next draw on liquidity. Where is price likely to trade to next? Below which old low? Above which old high? We look for a PD array in the direction of the weekly range bias. We target external range liquidity for this model. We anticipate price to move to an optimal trade entry that would support our weekly bias on the day and news release found on the economic calendar for the current or next trading week. This volatility injection is what we will wait for. This will be a run based on a low resistance liquidity run condition. Opportunity discovery. We're going to be looking for 30 pip ranges. Now, what do I mean by that? We're going to be looking for the probability of delivering a expansion that would cover over 30 pips, allowing us an entry to exit with a favorable 30 pip range. And we're going to be looking for that on a 60-minute chart that would enable a run to buy side liquidity when bullish institutional order flow is present, or target the sell side liquidity when bearish institutional order flow is present. Trade planning. When the market is poised to decline, we want to look for a convergence of both manipulation and price opposite to our trade bias at a time the economic calendar suggests a volatility injection would likely unfold. We will short 60-minute premium optimal trade entry setups. When the market is poised to rally, we want to look for a convergence of both manipulation and price opposite to our trade bias at a time the economic calendar suggests a volatility injection will likely unfold. We will buy 60-minute discount optimal trade entry setups. Trade executions. When we are bearish, we will anticipate a 15 or 5-minute premium optimal trade entry to form on a 60-minute retracement higher during London Open and or New York Open kill zones. Now, what am I saying here? Using the 60-minute chart as the basis, but narrowing down our focus to a 15 or 5-minute that's where the optimal trade entry that we're going to be hunting, the entry will be there. But based on a 60-minute price swing higher, that sets up that optimal trade entry, that would be a bearish entry, but located on a 15 or 5-minute chart. When we are bullish, we will anticipate a 15 or 5-minute discount optimal trade entry to form on a 60-minute retracement lower during London Open and or New York Open kill zones. Short trade management. When we are entering a short, we will place a sell limit order. We will execute with our demo account. We will use the 62% retracement fib minus 5 pips as our entry price when using the sell limit order. Long trade management. When we are entering a long, we will place a buy limit order. We will execute with our demo account. We will use the 62% retracement level on the fib plus 5 pips as our entry price when using the buy limit order. Short trade management. When we are entering a short, we will place a sell limit order to take 30 pips as our objective on a single position. If you capture a 30 pip objective, close the order via a buy limit order and wait for another opportunity. Long trade management. When we are entering a long, we will place a buy limit order to take 30 pips as our objective on a single position. If you capture a 30 pip objective, close the order via sell limit order and wait for another opportunity. Stop loss management. Stop loss opens with a 20 pip risk. When we are in profit 15 pips of our expected 30 pip objective, stop loss can be reduced by 5 pips. When we are in profit 20 pips of our expected 30 pip objective, stop loss can be reduced to break even. Money management. Position size calculation formula. Position size equals account equity times R% divided by stop loss in pips. Position size is the amount of leverage your trades or trades assume. Account equity is the total amount in your trading account. R% is the percent of risk you're willing to take on per trade. The difference between the entry price and your stop loss is the number of pips you will use to divide the result of equity times R%. Okay, in our example, our hypothetical account equity is $10,000 US. Risk per trade 1% or 10,000 times 1% or 100 US. Stop required for the trade is 20 pips in micro lots or 1K leverage each, which represents 10 cents per pip. 20 pips times 10 cents equates to $2 US. $100 divided by $2 equals 50 micro lots per trade or 1% of the account equity. We're always rounding down. In our hypothetical example here, using mini lots, everything remaining the same, 10K leverage, which would represent $1 per pip. 20 pip stop loss required at $1 per pip equates to $20 US. So $100 divided by $20 equals 5 mini lots per trade or 1% of the account equity. Again, always rounding down. And finally, for standard lots, it's not favorable and does not accommodate for that size leverage. If your demo account takes a loss on a trade and it is the full R% you assumed, drop the R% by 50%, and when the loss is recovered by 50%, you are permitted to return to the maximum R% per trade. If the reduced R% trade assumes a loss, reduce the R% by 50% until the previous trade loss is recovered by 50%. If you take a series of 5 winning trades in a row, drop your R% by 50%. You are likely to assume a loss eventually, and this will build in equity leveling and reduce the likelihood of a large drawdown. You want a smooth equity curve that slopes or stair steps higher, not erratic distribution with deep declines. Start backtesting. Collect multiple sample sets with this trade plan. If you are unclear about some of the process, rewatch the lessons for this price action model. I will provide sample sets, but do not rely or wait for mine. Dig into your charts and study what was provided here. Good luck.